Now, it's really, really important that when you are looking at investing, you have to treat this the way you would treat building a house. Hey guys, welcome back to the channel. So what we do here is we speak about investing and we try to give you foundational information to help you do research and make the best financial investment decision possible. It's all about education here. And over the last couple of weeks, I've been focusing mainly on trading 212 because I want to narrow down on something that I know that you guys are using, you like using, and it gives you a gateway into investing. As always, when you use them and you sign up, you get a free share. So if you do want a free share, make sure you use my link below. You can do the same with Stake. But essentially, they remove all the barriers to investing and you can access these companies commission free. But I also know that whilst I've done so many videos on trading 212, if you watch the dividend stock video and you watch the ETF video and some of the other ones, it can be hard to connect the dots. And the reason why I'm doing this video is because Sabrina messaged in a question on Instagram. Hi, Sabrina. And I thought, well, if she's confused, then there's bound to be other people who are confused as well. So this is what we're going to cover in today's video. I have built a pie or a portfolio in trading 212. It has 18 stocks in there, so companies. It's got 2 bond ETFs and it's got a property ETF in there as well for good measure. I'm going to be talking you through what I bought or what I put it into the pie, why I've put it in there, my rationale behind it. And we're going to be talking about risk, some key considerations if you're looking to do this for yourself. And we're going to talk a little bit about investment theory as well. But before we get started, off the back of the video on Tuesday, the Trading 212 team actually reached out to me to provide some additional comments that they think are really, really important when it comes to the problems that they face with the order executions or the delays therein. So I'm going to pin that below to make sure you check that comment out from Trading 212. We'll give you some insights into the work that they're actually doing and some of their thoughts as well. We've got a lot to get through, so let's crack on. So before we get started, I think it's really important to state, and I know that you know what I'm going to say, but please, please, please do not copy this portfolio or this pie that I've built and go and use it in your investment portfolio and just take it as that's good enough for me. Please use this video as a means, as a way of doing further research, something that you can use as a benchmark to sense check maybe what you've done. Please do not copy this. Please do not take this as financial advice. So with that being said, let's jump straight into Trading 212 and I'm going to show you what I've built. Now, just for you to be aware, I'm not going to show you the process of actually building a pie. If you want to know how to do that and it's new to you, go and watch this video right here. It's already created. I'm going to take you through each of the stocks. I'm going to talk you through what I picked, so on and so forth. So let's jump into Trading 212 right now and have a look at what we've got in there. So this is the app. And as usual, you need to go onto your portfolio and go pies. I've already built it. I'm going to go create. And these are the companies or the stocks that I've built in there already. So at the top, you've got 3 ETFs that I've selected. And down at the bottom is the list of companies. I'm going to work my way up and just list them, and then we're going to get into what they are as companies, why I've selected them, and how they're categorized on Trading 212 as well. So here we've got Johnson & Johnson, we've got Procter & Gamble, we've got Caterpillar, Coca-Cola, AT&T, Walmart, Apple, Alphabet, which is Google, by the way, Nvidia, Nike, Microsoft, Facebook, Tesla, Zoom, Pfizer. Then we've got 2 bond ETFs. Now, I've chosen a corporate bond. So a corporate bond is essentially a company. If you don't know what a bond is, go and watch this video right here. And I've also chosen a government bond ETF. Now, the shares is pretty much, it's a property ETF or a REIT, effectively. Now, let's talk about the companies that I've selected. Now, it's really, really important that when you are looking at investing, you have to treat this the way you would treat building a house. When you're building a house, your house is built on a very strong foundation. And this is concrete, this is reinforced, this is there because you're going to build your life and your security on top of this foundation. The same theory applies when you look at investing. You have to have really strong foundations. And for the many years that I've worked in, the investment industry, this is something that is core for any portfolio construction, whether you're adventurous or whether you're a cautious investor. This is something that is just foundational. It comes as a basic theory. Now, I have chosen to be the basis of this portfolio 6 dividend aristocrats. Now, if you don't know what a dividend aristocrat is, you need to go and watch this video right here, and you will understand what I mean by dividend aristocrats. In a nutshell, a dividend aristocrat is a company that has continually paid and increased dividends to its shareholders for at least 25 years. There are 66 dividend aristocrats. 6 of the companies that I've chosen here are dividend aristocrats. So, Johnson & Johnson, Procter & Gamble, Caterpillar, Coca-Cola, AT&T, Walmart. They are all dividend aristocrats. But in addition to those guys, there are also a few other companies that also pay dividends as well. So the likes of Apple, Nvidia, Microsoft, Nike, and Pfizer. They all pay dividends. Now, why have I chosen this? And what risk profile might this suit? And I'm saying might this suit because I don't know your circumstances. So please use it as a basis to do research. Now, if you are a cautious or balanced investor, then this may be something that would give you a really good foundation. I've chosen dividend paying stocks because they are generally companies that have low volatility, that have been around for a very, very long time, have really, really strong balance sheets, and they have cash available. Remember, dividends are paid from profits. So these are profit-making companies, likely with a lot of cash in the bank. Just take Apple, for example. Apple is the richest company on the planet. They pay a dividend. So I've chosen these companies specifically because they are there to be the foundation of this investment portfolio or this pie. In addition to you getting dividends, you also will benefit from the increase in the share price. And the whole idea of this is that you're giving yourself a little bit of security with the dividend payments being reinvested to help you along with hyper compound. Now, hyper compound is essentially the idea that because you're getting interest upon your investment returns and you're also getting dividend payment, which you're also reinvesting, it snowballs your outcome and your returns over the long term. And remember, in this instance, I said long term. Compound interest is more profoundly felt when you're investing for the long term, so 10 years plus. Now, who else have we got in this pie that isn't a dividend paying company? Well, we've got the likes of Tesla. They don't pay dividends. Now, Tesla is a speculative stock right now, and they have been for a very, very long time. But if you follow me, you know that I am bullish on Tesla, and the share price right now is absolutely incredible. So for a little bit of growth, for something that might give you the ability to realize some really good returns during your investment journey, something like a speculative stock may be something that you would like to select, because whilst you have foundations, what you're looking to do is actually grow your portfolio. You may not necessarily get the extent of growth from your foundation stocks like Procter & Gamble, Johnson & Johnson, in the same way that you would get the growth from Tesla, for example, right? So if Procter & Gamble grows by 3% per year in terms of their share price, you may have Tesla that grows by 40% per year. The idea is you have a mixture of stocks available so that you have the ability to expect or at least speculate for a different level of returns whilst also managing your risk. And this is a good segue into that conversation about risk, because oftentimes what happens is people get so enthusiastic about investing, all they simply do is look at the likes of Tesla. They look at the likes of some speculative stocks like Neo or Nikola, for example, because they are in the news right now and they're capturing the imagination. And whilst those companies are great for growth potential, what it doesn't do is give you a foundation. So you need to have a good approach, a balanced approach, or a pragmatic approach, at least, to how you're selecting your stocks and how you view your stocks. If you look at the likes of Facebook. Facebook is a consumer stay now, and it's a low volatility company. So they don't have a lot of competition, really, to be honest. It's woven into our day-to-day lives to the extent that there isn't really any competitor that can come along and take their place. It's a low volatility company. You think of the likes of Google as well. If you're searching on the internet, you're probably using Google. In fact, if you're watching me right now, you're watching me on YouTube. YouTube is owned by Google. So again, a big stable company, low volatility. There's Zoom in there because Zoom, again, is a relatively high volatility speculative company. Again, perhaps an opportunity for you to really gain the opportunity to speculate for growth beyond what your foundational stocks are going to be able to give you. So that's just a run through, very, very high level, of the stocks that I've chosen to go within this pie. Now, I want to talk a little bit about diversification. I talk about this, and this is a topic on my investment course. If you have not taken it, it's very worthwhile you taking it so you understand the investment theory and how and why diversification and asset classes are crucial to help you manage your investment journey. If you understand this, you will understand how investments are built. And the reason why I've chosen to bond ETFs is to simply put across this point. You do not want to put all of your eggs in one basket. Now, clearly, we've got 15 companies here. So you've clearly not put all of your eggs in one basket, but you have per se. Because when you invest, we have things called asset classes. Generally, equities, so companies, businesses like Procter & Gamble, Tesla, Amazon, Zoom, Alphabet, Nike, Microsoft. Those are all equities, and equity is one basket. The idea is that you want to put your eggs, your cash, in as many baskets as possible. And one way that you can do that is to utilize bonds and property. Now, bonds, if you don't know what a bond is, go and watch this video right here. I was surprised no one really picked that up, to be fair, but bonds aren't really that sexy. This is a really important video for you to watch if you want to understand how to manage your risk. But essentially, a bond is a more secure way of investing. You have a known return from the outset. Now, the issue with bonds is that if you're a retail investor, they can be extremely hard to access. You have to go to a bond dealer. And if you're not an institution or a bank or an investment house, it can be very, very hard to navigate, i.e. why things like ETFs are so popular. An ETF, again, is an exchange-traded fund. And within this fund, you put in whatever you want. So you can put a selection of bonds into an ETF and trade it on an exchange like the London Stock Exchange or the New York Stock Exchange. Essentially, its role is to give you exposure or give you access to a number of bonds. So I've chosen 2 bond ETFs here. One is a government bond, one is a corporate bond. Again, go and watch the bond video to understand what a corporate bond and a government bond are. Essentially, they are there to diversify. With a bond, you typically get a known outcome, but an ETF is an easy way for you to access that. So you are not just putting all of your eggs in the equity basket, you're using bonds as another basket to help you spread your risk with a known outcome. The other one that I've used here is property. So this is a property ETF or a REIT. It's the iShares UK Property ETF. Now, the reason why we use properties again is because it's just another basket. Now, in the investment world, we're not talking residential property. We're talking about commercial property. So that will be shopping malls. It will be office blocks. And you can obviously tell that would have been severely hit with COVID this year, but they are still a stable asset class to use. Again, if you've not taken the investment course, it is worth the investment. It's only £99.99. It's not £1,000. It's not £200. It is worth the investment just to understand this properly and how it's actually built within an investment portfolio. I actually give some examples in that course as well. But again, the idea with this portfolio is you've got some dividend aristocrats giving you the foundation. You have some speculative stocks in there as well. And you also have some bonds and property to give you some further diversification to help you manage your risk. Now, what you can do is if you are adventurous, you may decide that you have maybe 6 dividend paying stocks as your foundation, and you may select the remaining 9 to be speculative or high volatility stocks. And on Trading 212, you can search according to those categorizations. No one shoe fits all. There is not a definitive answer to this entire process. You have to kind of do what you feel is going to be best for you based on your research, particularly as you are doing this yourself. But for the purpose of this video, I kind of wanted to build something just to explain how to get a safe foundation if you are new and you're a little bit worried about maybe buying too many speculative companies, so on and so forth. Again, at the heart of all of this is a really important question. Why are you investing? What is your goal? You have to be clear on that. Look, I know that this has been a very, very long video and it's longer than I anticipated and wanted it to be. So I'm going to end this right here. If you have any questions or this has kind of made you think about anything that I've not covered, I'm sure there will be questions. Let me know in the comments below. But this is just a very simple way of perhaps trying to build a pie or portfolio, bearing in mind that you need a strong foundation. So please, 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 please bear that in mind. You have to have a strong foundation, whatever it is that you do. I hope you find that valuable. I'm sure there will be questions, so make sure that you leave questions in the comments below or message me on IG. Thank you, Sabrina, again for your question, because this has inspired this video today. If you're not listening to the podcast, there it is right there. We've only got 2 episodes left for this year before we get onto 21, and it's a brand new schedule. I've got so much planned for the podcast. So guys, as ever, thank you so much for watching. I hope you found that useful. Catch you later.